Hi there, eToro. My name is Wes. It is Friday the 14th of May, and that means it is time for my weekly update. Let's take a look at what has moved the markets. It has been quite a week. Blood everywhere. Blood on the floors, blood on the walls, blood on the ceiling, everywhere. So looking at the charts for some of the major indexes or indices, whichever is your preferred term, you can see that the 1 week chart, the NASDAQ has been selling off for the past 4 weeks, and we saw that accelerate through this week, taking the NASDAQ back to levels seen in January, so close to 0% return for the year. S&P 500, if you'd been following this chart, it might have been obvious that a sell-off was due because there had been 7 weeks where the index had closed in green. And we're kind of, at the end of earnings now. So that's usually when the sell-off happens. So we saw a sharp sell-off that shaved quite a lot of the index at its lowest point. The Dow Jones, which has usually enjoyed some green when the other 2 major US indexes have been red, followed along, as did many other assets, cryptos, commodities, etc. And our poor little FTSE 100, which hasn't yet managed to return to levels pre-pandemic, is a bit of a copycat, and so followed the US indexes down. But I mean, so did most indexes. Right, looking quickly at performance. So this is it's a daily chart going back roughly a year. So these are the annual performances of the candles or the S&P 500. So that's sitting at about 46%. The NASDAQ, which usually beats the S&P 500, well, has historically usually beaten it through the past decade or two, decade and a half, is now more or less in line with the S&P 500, which is quite unusual historically, but we all know why this has happened. And then on my chart, when we looked at this last week, we were sitting within this plateau kind of range, and I have followed the market lower this week, as you probably will have known, losing a few percentage. Again, I'm not majorly concerned. There have been a lot of opportunities through the sell-off, and I've been taking advantage of them, which will do us well in the future. I've also included ARK's Innovation Fund on this chart, and the reason I've done this is because I think that ARK has had an outsized effect on the market. I think it had an outsized effect on the way up, and now it's doing the same on the way down in several ways. So I think technically, but also in terms of sentiment. So ARK's holding in that fund in particular, these are the top 10 holdings. One of them is Tesla. Tesla is a large part of major US indexes. So when Tesla sells off, when ARK sells off, Tesla sells off. And when Tesla sells off, you're probably looking at a big dent in the performance, if not a sell-off, in some of the major indexes and funds. So as ARK has sold off more and more, it has affected some big tech companies, and those big tech companies have affected indexes. And selling off those indexes means that people they get scared, and they panic and they sell things in those indexes because they don't want to lose money. And so this becomes a bit of a vicious circle. On top of that, we also have the algorithmic traders, so software robots that are able to trade in the markets, and they trade on certain technical signals usually. And when they see certain things happening, like big sell-offs or big buying events, they add to that by doing the same thing. And in reinforcing these actions, they mean that they exaggerate not only the speed of these sell-offs, but also the depth of these sell-offs. So ARK, I think that they have hurt the market. They helped the market on the way up, and they've hurt the market on the way down, had an outsized effect well beyond their effect in terms of their assets under management. Of course, ARK has some really speculative companies in these ETFs, and I think that's what people really have been trying to offload in anticipation of higher rates. They hold companies that aren't making a profit, aren't anywhere near making a profit, and in some cases aren't even making any revenue. And so people rushing out of trying to get away from those stocks, sell their ARK, and then we see this massive cascade effect that has tainted the wider technology spectrum when there are still a lot of good companies in there. Okay, so I've kind of spoken about this before. So my realized profit over the past 3 months, despite the awful unrealized P&L here, has been about 10%. And at a high level, I have several strategies that are in play. I call them themes. And I can't control the timing of the market. No one can. But when certain themes are doing well and they're starting to top out, then I start selling out of those themes. Then hopefully I have a profit from those themes, and I start taking that money and I pour it into other themes that have yet to perform. And so you'll see some of that has been happening through the past week. I've also been hedging a little bit. There've been some misses in my hedges, but I think overall I've made some money. Although I did sell this company because their earnings were awful, and I think they're going to have a tough year. So, long story short, take money from things that are working well at a profit, hopefully, so that you've expanded your amount of available cash. Put that money into other themes or strategies that, for one reason or the other, haven't yet started to perform, so that when they do perform, there's a bigger base from which they're going to perform. And so I have been buying into some very strong companies as the markets have been dropping. And the markets will turn because they're being unreasonable in several areas. I can't control when, but it'll happen. So just a few of the things that you will have seen that I've bought. There's a bit of a range of things. Some of them are tech companies, but where I have bought tech companies, they tend to be those companies that are able to make their own money and they're established businesses. Palantir is the exception, but it is a very small position. Okay, so on to what really hit the markets this week. So last week, Friday, we saw unemployment numbers come in much lower than anticipated. The market celebrated. It said, okay, cool, the interest rate increases are further out than we thought, because if unemployment's low, then the Fed isn't going to increase those rates. Hooray, buy growth, stocks, speculative stocks, market rallies massively on Friday. On Monday, the market completely changes its mind for whatever reason, says, nah, and it sells off all of the things that it bought on Friday. On Tuesday, I think it had rallied a little bit again, and then was it Wednesday that the CPI data came out? There are many ways to measure inflation. So on Wednesday, whatever day it was, CPI data, so consumer inflation data, came out, and it was much higher than was anticipated. And this spooked the market like crazy. Now, I've been following the inflation narrative for probably a year now, maybe 9 months. And I've read up a lot about what the economists are saying and forecasting, and they've all been saying just about that we can't rely on these measures right now, because the measures only work when the market is settled and homogenous. And because of the lockdown that we had and the opening up that we're going through, the data isn't homogenous. We have huge supply shocks and huge demand shocks through the wider economy, which mean that these numbers are distorted. And this happens. This is not the first time this has happened, by the way. These economists are not just making shit up. You can read books that will tell you how this happens and has happened historically, typically when there's a war or after a war is finished. But there are other situations where they happen too. So massive sell-off, everything's selling off. But if you looked at the details of the basket of things and what had increased the most within the consumer price basket, you will have found that there were just a few things that had an oversized effect, and that these things, where prices had increased a lot in a short amount of time, were probably very short-lived. So I'll use an example. I'm not going to talk through all of the different elements. This is a fantastic article that talks about the hows and the whys. But I'm going to simplify this, by the way. But so one example is, when the world shut down last year, companies that rented out cars, so like Hertz as an example, when they rented, when there was absolutely no one that wanted to rent a car because everyone was staying at home, they had a big problem. They had no revenue, and they were eaten into the cash reserves. So they offloaded their cars. Let's say they sold them. They didn't always sell them, but let's say they sold their cars en masse. So all of a sudden they're selling these cars probably on the cheap to generate cash reserves so that they can weather the storm. And they were fine. They sat, well, not fine, but they had money to weather the storm, and they just sat and they waited. Now, as the world started opening up, it happened very rapidly, and suddenly they had individuals that wanted to buy cars, but also there were people that wanted to rent cars and be able to travel. And because of various elements, so new cars, the number of new cars available has been constrained by the semiconductor shortage. But also because there were so many people looking for cars, the secondhand market suddenly became inflated, the secondhand market for cars and vans, etc. So this drove a whole bunch of weird behavior in the economy. It's actually really interesting. So there were people that were so desperate for secondhand cars that radio advertisements about secondhand cars, they shot through the roof. And there were even people cold calling, going through the phone book and just cold calling people, asking them if they had a car to sell. And the demand was severe enough to drive the prices up over the short term. And this is one part that's had a massive effect on the CPI number. Now, you can imagine this is playing out all over the economy in various different ways. But even now, the demand for secondhand cars, to some degree, has abated. And that's because the demand has been fulfilled somewhat, and so the market is starting to return to its normal supply and demand curves. This is going to play out everywhere. This is the kind of thing that's happening right now with commodities. It's the kind of thing, to some degree, that's happening with semiconductors, although semiconductors is also a growing industry. And so this happens, it has a massive effect on a measurement, and then after a while it dissipates and the market normalizes again. So, long story short, the headline is not as bad as it seems. Always look into the details. Similarly, the next day we had the PPI data out, which is another measure of inflation. And I don't have as a detailed article about it, but everyone that knows about economics and studied the history and the science of it is saying, we think that this is a short-term shock and that it's going to settle down. And this is part of why you would have heard maybe you have heard that the Fed Reserve Chair, Mr. Powell, has been saying he thinks inflation will spike, but it'll be transitory. It'll spike and then it'll level off, probably at a level higher than it was before. It'll increase slowly, as it does in normal times, but it'll be a spike and then it'll taper off. And it's because of these kinds of things that he's been saying that. And he's not just, making it up. It's based on what has happened historically and the understanding of the current situation. Now, inflation is going to increase. And when inflation increases, rates will increase. Right now, the market is treating these events as though they are absolute poison to the stock market, as though when they happen, it's going to be the end of the world. No one's going to buy any Google stock ever again. They're just going to sell it. The stock market's going to shut down. Everyone's going to go home. I'm exaggerating a little bit. I'm prone to exaggeration. So that's obviously not going to happen. We're in a very, this is the Fed interest rate, the chart going back 10 years, 25 years. So what I wanted to show is the market is overreacting to this information. We can tell that it is priced into the stock market to some degree by the fact that the NASDAQ is trading behind the S&P 500, which is very, very, very unusual. So technology stocks are telling us, the price of technology stocks and the technology indexes are saying that people are pricing in future interest rate rises already. Otherwise, the NASDAQ would be beating the S&P 500 like it usually does, hands down. So bear that in mind. Some part of the rate rises are already priced in. This data came out earlier in the week, the market dropped off even more. So if it was already priced in, why did it drop even more? On top of this, could it be that the discount in technology is far larger than it should be? So just as an example, we can see the rate increase here from roughly 2016 to 2020. And if we look at this range of time for the NASDAQ 100, we'll see that roughly in that range of time, the NASDAQ increased 84%. So rate increases don't necessarily mean the market goes down. What about the S&P 500? Okay, over that same period, rate increases, S&P 500 increased 54%. Was this a weird one-off for some reason? 2004 to 2008, we see a rate increase to roughly 5% over a fairly short amount of time. Nasdaq 100, it didn't put in the gains that we have been seeing recently, but over that period, 52% increase. S&P 500, 39% increase. And so this is what is a little bit confusing well, it's not confusing, it's kind of expected because this always happens before the rate increases come. The market becomes so obsessed with a particular point of data and starts to invent its own narrative around it and becomes hyper-focused on it and doesn't think about what's going to come next, that it acts based on that particular point in time. And it usually overreacts. And this happens on the way up and it happens on the way down. So the market has been a little bit nuts right now. We can all tell that because GDP is forecast to grow well. A lot of the companies that are selling off have put out really good earnings and also forecast really good business growth through at least the next year and potentially beyond. So when all this craziness is happening, just try to bear that in mind. Okay, I've been talking for a very long time. I'm going to try to do this last part very quickly. So for the past week, we've seen some stocks sell off the most. This is more or less my portfolio. So absolutely hammered the set of stocks. I don't hold a lot of what I would consider speculative stocks in my portfolio. I think it's like maybe 1 to 3% of the companies that I hold are companies where there's a risk that they won't make enough profit or profit quick enough without requiring to take on additional debt. I think maybe I have like 4 companies and the position is quite small. So Overstock sold off 16-17% this week. Overstock, for those that don't know it, it's kind of like made.com in the UK and Europe. I'm not going to do a deep dive because I don't have enough time. I would love to do a deep dive, but I'm studying at the moment, so I don't have enough time to create more than 1 video a week, and even that's been challenging. So Overstock, right, this is a company that is dropped off massively this week. Revenue is more or less in line with market cap. They don't have any debt, I can tell by the enterprise value. But you can also see it down here. So this is a company that has money. It's also a company that is able to make its own money. Margins are fairly thin, but this is typical for a growing company that's trying to secure a market. And then once it's grown to a certain size and achieved scale, then they typically start looking inwards and optimizing margin. It has, which so on the face of it seems like a high PE. So 37 for 2021, 31 for 2022. But then when you look at the forecast EPS growth, it's 131% through 2021. It's 19% through 2022. Not as great, but also you have to take the 2022 number with a pinch of salt. So a company with massive growth prospects, that is a healthy company that's making its own cash, it is profitable, and could easily survive interest rate increases, lost a huge percentage through the past week when inflation fears were driving everyone to get crazy. So it just doesn't make sense. This is a good company, not just for the reasons there's a lot more detail to this, but this is a good company, even if you just look at the books. Zepp Health. I know some of you probably are tired of hearing me talk about Zepp Health. So Zepp Health is a company that creates wearable devices. They have had a heavy reliance on Xiaomi in the past, and they're busy building out capabilities so that they have their own brand, which has been enormously successful through the past quarter. They sold off massively yesterday because they released earnings and there was an earnings miss. It was a significant earnings miss, but the reason for the miss are temporary. And they're saying they'll be back, they'll be profitable next quarter, and they're also forecasting something like 42% revenue growth through the next quarter alone. The market cap of this company is less than the revenue. The PE ratios, especially the forward PE ratios, are nuts when you look at the EPS growth that the company expects or that the market expects from the company. Once again, it's a company that's making money. It's got thin margins because it's a growth company. It's creating physical devices, lots of R&D. But if you look at what their management is doing, it is incredible. This is a fantastic business. No debt, lots of cash on hand, Canada weather, and increases to inflation and rates. I think so. I think that this company is definitely a multi-bagger. By the way, some of the devices are looking pretty good. Alibaba, we all know Alibaba. Big sell-off yesterday, minus 6% on an earnings miss. I don't understand why. So they actually made a lot of earnings, but they had to pay the enormous $1 billion plus fine that the government issued for antitrust, breaking antitrust rules. But if they hadn't paid that fine, their earnings would have grown massively. There was a little bit of a slowdown in their cloud computing division, but this was because they lost a big customer, and they've said that they've got large diversification around the rest of their customer base, and they expect the big growth to continue. So once again, this is a big company that's growing fast, that's sold off massively, and is priced kind of at the level of 2018, when their revenues were 1/3 current levels and their profit was one-third of current levels. It doesn't make sense. I don't think the market's even pricing in the Ant Group IPO, which I think will happen, but the company will be worth less. So again, bargain bin prices for fantastic growth companies that are making profit and are cash rich. Similarly, Micron, a leader in its industry, one of the semiconductor companies, they make memory, they dominate their segment of the market. Once again, a company that has incredible earnings growth to come through the next 2 years. Margins are a little bit better, and margins are going to get better for semiconductor companies because of the shortage of semiconductors in the industry. Once again, cash-rich company, no debt. Stock price has dropped off significantly from the recent all-time highs. No reason really for that to happen. This company's share price should be going in the opposite direction. And again, so lastly, SolarEdge. Now, SolarEdge is a little bit different because, well, it's lost 42% of its share price, but it was insanely expensive when it started dropping in January. But since coming off of these highs, it's looking very, very, very attractive. The valuation here is saying like 12, but I think that's because of the trailing 12-month numbers. And solar companies actually most of them had a tough 2020 because of the lockdowns, and because a lot of what they do needs people to be physically present to do things and install things. So demand dropped off a lot, their capabilities dropped off a lot. So 2020 was a bad year, but once again, you can see EPS growth through 2021, 2022 are fantastic. Now, this isn't the only research that you should do on these companies. I'm trying to do this very, very quickly, but you can see from the perspective of the way these companies are run and their books, there's no reason that inflationary fear should be affecting them massively. And they have. The baby has been thrown out with the bathwater, as you've heard me say so much recently. Okay, so that's it for this week. I know it's been a tough week. It's been a bit of a tough month. Try not to let it concern you too much. We're getting rich slowly. We have fantastic companies in the portfolio. I think tech has just been tainted a little bit, particularly by the more speculative elements within the technology industry, but it's feeling massively oversold at the moment. Rising rates and inflation are not the end of technology growth forever. We just need to make sure that we are picking companies that are well suited to that kind of operating environment. And we have. All right, have a good weekend, and I will speak to you next week. Goodbye.